This is the Elevate Media Podcast, created for high achievers on a mission to continuously elevate their life and business. Now here's your host, Chris Anderson.
Welcome back to another recording of the Elevate Media Podcast. I'm Chris Anderson, your host. Today, we're going to be learning all about how growth equity really works. I'm excited about this. I'm going to learn something right along with you guys. So we brought on an expert who's a partner at Volition Capital. Invests in high growth, primarily bootstrap founder-owned companies, and a lot of experience in this market, in this world. So Jim Ferry, thank you for being on the show today.
Yeah, thanks, Chris. Appreciate it. Thanks for having me.
Absolutely. Yeah, for sure. Looking forward to doing this. So let's jump right into it. For those who don't know, what is growth equity?
Yeah, growth equity. So I think a lot of people are familiar with traditional venture capital. Think about that as the show Silicon Valley on HBO, where someone's investing on an idea or maybe the back of the envelope, sketch of what something could become. So many times there, you're kind of backing a team and you're taking, product market fit risk. On the other end of the spectrum, I think people tend to know about private equity. All of this kind of falls underneath the umbrella of private equity, but I think when people hear private equity, they think about the LBO shops, the leverage buyout firms that are using a lot of debt and they're acquiring these large businesses. We kind of fit in between when you think about growth equity. So Volition, for example, our typical check size is somewhere in the 15 to 60 million range. We tend to invest in high growth businesses that have found product market fit. So the way that we define that is, somewhere over 5 million run rate. So you have paying customers, a real product. When we come in, we're really taking out kind of the product market fit risk and taking on sales and execution risk. So where our capital is used is many times just to put on the balance sheet. People are going to invest ahead of growth, whether that's for most of the time it's for kind of go-to-market sales and marketing investments as well as product. Sometimes we also fund acquisitions if someone's looking at acquiring another business, and we can kind of help on the diligence front there. And then third would be sometimes, especially in the business that Volition backs, we tend to back founder-owned businesses. Many times they're bootstrapped, which means they haven't taken on capital. For the most of the time, they've taken on kind of small sums of institutional capital when we get involved, which is really our model, not necessarily strict to growth equity. So we're open to providing some liquidity for those founders to kind of de-risk their position. Most of the time, all of their net worth is tied up in their business, so they can de-risk. It allows them to kind of free up to go for a larger outcome. So we are not majority owners of businesses like a venture capital. We still own a minority piece, and we're just hoping to be a good partner along the way. Across a lot of different value add areas, but hopefully that answers your question.
Yeah. So you said de-risk of a founder-led, bootstrap business. So what is that kind of like? I guess let's dive into that a little bit. Because you said you're minority owned, and so you don't take a majority. So how does that look for the owner, for the founder that partners with you guys? Are they stepping away to let you take over, or are they still running it? And let's kind of like explain that a little bit more.
Yeah, totally. They are still running it. We back people just as much, if not more, than we back the business. Because people make the business ultimately, and we like the saying that we're in the people business. So even as I think about where I spend a large portion of my time, I'm on the road a lot, and that's meeting founders face to face all over the country. And you just learn so much more about a person and their business sitting across the table from them. And I want to feel like, if I back this person, we can have a good partnership. And we joke a little bit but it's the truth that the investments that we make, time horizon, think 5 to 7 years, something like that. Really no strict, end date when you need liquidity, but ultimately we have investors that need to get liquidity at some point as well. But over that, if you think about a 5 to 7 year hold, statistically, that's longer than the average marriage in the United States. So you need to like the person that you're working with.
Right.
That's why I spend, a lot of time on the road. And to get back to your question, so we're backing these people. We want them to continue to run the business. We are not going to be placing our own management team in. That's more of like a majority private equity type model. That being said, we help in a lot of different ways. So we do have a talent team internally that can help the existing management team hire world-class talent around them if there's any holes. Many times they're wearing a lot of hats. We're not placing our own people. We're acting as a recruiting firm on their behalf. Essentially, it's their decision. But at the same time, they can save on the recruiting fees because we're not charging for that. Obviously, it's kind of comes with the investment. We also have a marketing team that helps with PR and branding and so forth. We have a lot of inter-portfolio events that we do in Slack channels for everybody in specific areas and functional groups so they can bounce ideas off of each other. The list goes on. And we just try to be a good partner in that sense and try to make connections and sometimes challenge them. Because I think one thing that I certainly find while sitting on the boards of these companies that we invest in is equity value creation doesn't always equal revenue growth. And what I mean by that is like you can have, there are certain lines of business that are going to have a higher multiple attributed to it. Or if it's a high churn line of business, then that's not going to get the same multiples. So we bring a little bit of a different lens from someone that's in the weeds. We can take a 30,000 foot view of, hey, how do we build equity value over time?
Okay. So when a founder, what is the purpose of them coming to a group like yours to seek this? Are they specifically looking for just help, guidance, the capital, both? Like what's usually like, hey, Jim, I need your help. Here's why.
Yeah. So I wish they all came to us. Taking a step back of how do we find deals that we want to invest in? A traditional kind of growth equity models, we have a team of 15 analysts or so, and they're talking each to 20 plus founders on a weekly basis and kind of bringing the ones that fit our investment criteria to our investment pipeline committee every Monday. So we have a lot of third-party tools and as well as first-party tools that we've built to kind of help them identify interesting companies. Every growth equity fund is using similar tools. So like we all know what are potentially interesting companies. So it's about finding a diamond in the rough that might be under the radar or just breaking through to them, which going back to why I spend a lot of time on the road. That's a great way to break through. Sometimes I'll go talk to someone and they get 12 to 15 growth equity funds emailing them to hop on a call a week. They never take calls. I'm the first or second meeting that they've taken in Boise, Idaho, or pick your random city. So that's kind of how we find them. But I think why are people receptive to having the conversation? As I mentioned before, it's kind of one of three pillars. They need capital because they recognize an opportunity where, they can scale much faster and capital on their balance sheet is a limiting factor to the rate that they can grow. So they say, hey, we know that for every sales rep or every dollar that we put in sales and marketing, we're going to get $3 out. That's a great time when you should pour some fuel on the fire, take some capital, scale faster before the rest of the market catches up to you. With success brings competition. So that's kind of one. Number two would be, as I mentioned, shareholder liquidity. If they want to take some chips off the table, that's kind of a common saying. And that basically means, a founder might own 40% of the business or something, and they may want to sell 5% of their total ownership to get them down to 35%, and they can get a couple $1 million. That gives them security. They could buy a house, put their kids through college, and then that kind of frees them up mentally to go for a larger outcome, I think. And the third would be if they're looking at potentially tuck-in acquisitions or something like that, we can help there. So those are three reasons that people will come to us. But there's a lot of sources for capital. I think most of them, when they're talking to us, they're looking for something besides just money. They want some value add besides capital. And that's where a lot of the stuff I talked about around the talent team, marketing team, interportfolio, bunch of the other stuff that we're doing is attractive to them because we can kind of help them along the way.
Sure, 100%. And so with that too, and I know you kind of mentioned it a little bit, I want to kind of dive more direct into it. So when you meet with these individuals, you're in the people business, right? You said, so when you meet with a person, what are maybe some three things that you're looking for to be like, yep, we definitely can partner with them. Do you have kind of something like that, like KPIs or traits or anything that you look for in that individual first before, even the business metrics?
Yeah, the business metrics, like they're on our website. Like we have a very strict criteria. It's like 5 million plus in revenue, haven't raised a ton of capital to kind of get to that zone. High growth rate, et cetera. All of that is table stakes. We talk to a ton of businesses that have that. And as we're evaluating the team, number one is aspirations for greatness or to build a big business. So one of the questions I ask a lot is, well, tell me what this looks like 35 years down the line. And, I want someone to be thinking big, however realistic.
Sure.
If they tell me this is going to be, we're at 5 million in revenue today, or 20 million in revenue, and next year we're going to do $1 billion of revenue, like we've lost the plot. Like that doesn't happen.
Right.
So I want aspirations for greatness, but in a realistic manner. It's, hey, this is where I think I'm going to be 3 to 5 years from now. And it's, hundreds of millions of revenue or something like that. But and here's how I get there. And I think the best founders that I've backed think about the 3 to 5 year plan and then decouple that into, all right, how do we set ourselves up this year in order to accomplish our goals in 3 to 5 years?
Right.
As opposed to some founders that I talk to that are so focused on, all right, I got to grow 100% this year. And they're not thinking about what the product roadmap looks like or what the longer term strategy looks like down the line. Both are important, but I think you're never going to get to the 3 to 5 year if you're solely focused on 1 year. You need to think about that. So that's kind of one of them. The other one that I think is like one of the traits that I've found in some of my more successful investments is the founder knows what they don't know. They're very upfront about, these are my strengths. Here's where I have a blind spot. And that's where we can help them, acting as kind of their outsourced recruiting firm to help fill those blind spots. So sometimes it's like, we've gotten this far on, I know how to code a little bit, especially in an AI world, but we could really benefit from having a CTO that can take this product to the next level or something, and we can help hire that. I think third would be someone who thinks about the marketing competition. I hate when you ask someone who are you competitive with, and they tell you nobody, because that's truly never the case. You always have competition. This, I think, gets back to being realistic. I think you lose a little credibility when you say that. So I think it's like, hey, here's who our competitors are. Here's how we win, and here's how we lose. Or why we lose against them, and here's what we're doing to better our win rate. Like those type of things, I think, go a long way in my mind. So those are probably 3 that come to mind amongst a lot of others.
Yeah, and those are good things to look at for sure. And so, when you what's for you then on the flip side? So you found this business, you partnered with them, invested in them. You have your time frame that you partnered with them. I think you said like 5 to 7 years usually is roughly.
Yeah, that's pretty standard. Yeah.
Okay. So what's that exit like? What are you looking for, or what's that look like at the end? So how does that kind of come to a head? I guess, do you have a KPI, like our goal is to get you here, and then we will step away, take our portion, or how does that look like at the end of the relationship?
Every business is different. I'll give you a couple different flavors of it. Like there's some businesses where they recognize an opportunity to maybe raise more capital. So maybe we made a $20 million investment, and they're going to raise more capital. We can either take all of that round potentially if we think the valuation is fair, or we tend to get what's called pro rata rights. So if we own 20%, if the next round is 100 million, we get to take 20% of that 100 million. That's very common. So we can get more capital in the business over time. So that's one. Another option is if there's another financing, which happens sometimes, and it's at a big valuation, it's a good markup. We have to return capital to our LPs too. There's scenarios where we might take a little liquidity and ride the rest. So there's been a few companies that I'm on where you take our cost basis off the table. So let's say you invested 30 million. A new investor comes in and they want to write a bigger check. But we don't need that much capital for the business operations. One option is everyone takes a little liquidity. So we'll take sometimes, if we invest 30 million off the table, now we're playing with house money. We still own a good portion of the business, and we're going to ride it to a larger outcome. That's another one. When we're going to exit the business completely, there's a few different routes to that. One would be IPO. That's a little more rare. You need a lot of scale to go public today, and it's a headache. And you got to feel like this business has like a long runway. The other would be to a strategic. So if you rewind, I don't know, 20 plus years ago, most exits happen to strategic. So that would be someone else in the space. So if you have a CRM business, maybe Salesforce buys you or something like that. However, I think that this market has matured where there's a lot of dollars from financial sponsors. So the large private equity funds. That's where the majority of our exits have been. So that would be like the Thoma Bravos of the world, the Vista Equities of the world, who are kind of names people might know in this space of the large private equity funds that are acquiring businesses, of our scale. We help along the way. Sometimes we act almost as a quasi investment banker. So we're building decks and kind of handling a lot of the communication on behalf of our portfolio companies. Sometimes we hire an investment bank to run a full process, but we are, as minority equity investors, we're never forcing the business to sell. So it's not like, oh, hey, we got to this, what we think is this valuation multiple of return, so you guys need to go sell. That's not how it works. Like, we don't own the majority of the business, so it's hard for us to force that. We can't. So many times we're constantly having conversations at the board level of like, what does the market look like? What the multiples are? What are our growth prospects? Is now the right time to think about liquidity? And it's kind of a group decision. Sometimes there's been times the management's like, hey, I built a lot of equity value. I think now's the time where we want to exit the business and test the market. And we're fully supportive of that. So it depends.
Okay. Interesting. And so with that, like where we're at in the world right now, do you see certain marketplaces growing that are going to be more dominant versus others that are fading right now?
When you say marketplaces, do you mean like sectors, or help me understand that?
Yeah, it's sectors or where you could be investing in businesses, certain type of avenues there.
Yeah. I mean, we can't have this discussion without talking about AI, right?
Of course. Yeah.
So AI is it's pretty incredible actually, because I would say like 6 months ago when I went to board meetings, everyone's talking about AI. The way that people are using AI for the most part was make them better and faster and efficient at coding, number one. But it wasn't like a game changer yet. And I feel like a lot of people were just talking about AI, but really just using it as a super Google search engine and to help them write emails.
Yep.
Fast forward to now, 6 months later, things have changed. Like the new update of Claude, and how easy it is to replicate products. And I'll give you an example. I have a portfolio company. We just go back from a board meeting, and they eliminated $1 million of third-party software expenses because they just built it in-house. So they got rid of 3 software products that they were paying for. Like, that could have never happened before because code used to be defensible.
Right.
It's not anymore. So you need to think about what makes a business defensible in the long run. And I think that there's a lot of AI companies, people I think have gotten wise about this, but maybe 2 years ago that were really just a wrapper on top of someone else's technology. So what I mean by that is a user interface on top of OpenAI's technology. They're very easy to replicate, but they gained a lot of traction fast. With success brings competition. Now the market is saturated with tons of different vendors. It's a race to the bottom on pricing. Right. That's tough. However, there's AI businesses that I think are durable and super interesting. And you got to ask yourself, like, what is durable about this business in the long run? Whether that's AI business or any business that we look at.
Yeah.
So that could be something like, they have a moat around first party data. It's a complex ecosystem where I don't care how good at AI coding you are, like, you're not going to be able to just enter this. So sometimes that's regulated, or industries with compliance like healthcare or cybersecurity, et cetera. Sometimes having a distribution advantage matters. So you're something about your go-to-market strategy and channel partnerships is why you're going to win, and on and on. So I think every company that we're looking at, we're asking us that question: what is the long-term durability that prevents a dozen other people from creating a similar product?
Right.
And then I'm also thinking, okay, there's these AI businesses. What are business models that are less disrupted by AI? So that would be a marketplace business, for example. Like, you can't just, like, a marketplace business, many times it's not the technology that's the unique factor. It's that you balance supply and demand, and it's chicken and the egg. And there's kind of a network effect that happens. So I've made a couple of marketplace investments. We've done a lot of
Can you explain what marketplace businesses are?
Sure. A marketplace business is one where there's kind of two different constituents on each side. So let's give an example. From a consumer perspective, that could be Uber. You can view that as a marketplace. There's drivers and there's consumers. I don't care how good AI is. It's very hard to get people to you could probably code what Uber's doing. That's not the secret sauce. The secret sauce is that they have all these drivers and all these users that are using it, has created this flywheel effect over time. So that's kind of one. And there's a lot of different examples of that. It doesn't need to be consumer facing. It could be B2B as well. Another one, where Volition has made a lot of investments is hardware. We're calling it hardware as a service, investment. So think about that as a software business that has a hardware component attached. So an example of that would be, I'm invested in a business called Butterfly MX. It started as kind of a smart intercom for multifamily buildings. So you can call someone to get into the door. So there's a hardware component, which is, you can't spin up with AI. That makes it very sticky from a retention perspective. And then there's a software component of recurring software on top of that. And they've since expanded to be a full suite of access controls inside the building. But we've had a bunch of those, and that's hard to replicate. So there's AI businesses. What is the durability? And then there's, I'm also putting my hat on to say, what are markets that are less disrupted by AI?
Right. Interesting. Yeah. And it's so rapidly changing too, which is crazy with AI. And I hear people talking about vibe coding and everything that's just changing so quickly. Thinking of it as like the durability of the business and how it can have a longer lifespan, basically. Do you ever find people, you start having conversations with these founders and they just have a really hard time wanting capital? Like, I guess
all the time.
All the time. It's like
most of my conversations are someone taking the call because they realize, especially where we play, because we're not, Volition's strategy is we're not chasing the Silicon Valley type company that's raised hundreds of millions of dollars and is going to grow at all costs, and the unit economics will catch up. Like an OpenAI and ChatGPT is a great example of that. Like, it's an unbelievable company, but they're burning tons of capital. It's just not like the type of business that we go after. And obviously there's a world for that, and people making a ton of money there. We're going after businesses that are more capital efficient, but still have aspirations for kind of greatness, and to build a big business. And maybe they've kind of, haven't raised capital to get to this point. And so now they're starting to think about, hey, I'm recognizing now that I can scale much faster with a partner, along with capital. So most of the conversations I have are people that are saying, hey, we're capital efficient, we're break even, maybe we're profitable, so we don't necessarily need the capital. We see this big opportunity, and just starting to have conversations. And in my mind, if they're having that conversation, there's something in the back of their head that's saying, hey, maybe I should take the capital. Otherwise, they would never be on the call with me. And so we stay in touch. If it's a really good business, that's when I hop on the road. I go spend some time with them. We talk a little bit more. And sometimes you can catalyze a deal that way because someone just gets to know you and they trust you and, start to understand more what this could look like for their business. Other times, you build a relationship. We have a business now that's under signed term sheets for us to due diligence and potentially invest. And I think we've met them 6 or 7 times in person. So we've built this relationship. They finally said, now's the time where we want to raise capital. So it tends to be a mix, but I'd say most of the calls that I have on a weekly basis are people that are not pressing go on the capital raise yet.
Okay. How do you prepare the founders for that? I mean, obviously having meetings, but like what should they, if they're a founder and they're about to take on this equity, this capital, how should they be preparing themselves on the changes that are coming? Because that's it's almost kind of like a light switch, right? Sort of.
Yeah. So there's 2 things. Like, one is like, I think that one of the reasons sometimes people say like, hey, we're going to raise next quarter is that they need to get prepared in order to raise. So that means putting together their financials in a way that's easily digestible for someone else, and like anticipating some of the requests that someone like us may ask from a data perspective, and just having all of that ready to go off the shelf. So that's like part of the reason why some people wait a little bit to get prepared. Mm-hmm. I think your question was also saying like, how should they get prepared to take on a investor for the first time? Sometimes we're the first institutional investor, which means they might have not even had a board of directors before. Right. Now we need to have we're going to have quarterly board meetings. And what does that look like? So you need to be prepared for that. And that's part of the transition of growing up as a business and, a good corporate governance, and so forth. But what we say is like, we do a lot of diligence, on talking to the founder, asking them, tons of questions about their business as part of our diligence process. We'll, if it's a B2B business, we'll talk to their business customers. If it's B2C, many times we'll do a customer survey. So we get to know the business and the people running it and their customers well. they should be doing the same thing for us. Understand who we are, what type of underwriting and return are we, looking to get out of a partnership and investment. We always give references of other folks that I've backed in the past, like, those people should be talking to the founders that we're potentially investing in. And once again, you want to feel like it is a partnership, not just me as an investor coming in. I don't want to be this big bad guy. Like, we're investing in high growth businesses, so I'm not going to come in and fix something that's not broken, but understand how we're thinking about return thresholds and burn and all that.
So have you ever came into a business and once you got involved, the founder who's been used to making the decisions, doing all this, now has to answer to other people? Has there ever been some friction that either, I guess, would a deal start and then be like, oh, never mind, this isn't going to work, or have to really go through some friction to help the founder understand, like, you have to have a board, like, and answer to these individuals, things like that?
They should know upfront, like, what expectations are. So there have been scenarios where we like a business, we are in the ballpark on valuation. So the next step from there is send a term sheet. And the term sheet, since we're minority investors, we need to have minority protective provisions. It'll be things like, you can't take our capital and go put in a swimming pool at your house, or you can't all of a sudden, hey, if we own 20%, you can't go issue new shares. So now all of a sudden we own 5%. Like, we need to know what we're buying. So a lot of those are common sense. And then there's certain things like, you got to approve the operating budget for the year. Now we're not going to be pinned in the butt on that. And but some people are like, well, I know my business really well, so I don't want you coming in and telling me how to run it. That's not what I want to do at all. That's actually the opposite of what I want to do. In a great scenario, you just continue to grow, and you're, I'm a career investor. I've never been an operator. I can't do your job. So that's not right. So I think it's just kind of making sure that they understand, what this looked like. But there have been scenarios, of course, I wouldn't call it friction, but people are like, and I have a very good relationship with all the CEOs that I back. We're in Slack channels all the time. We spend all the time together. And, there's been times they're just honest with me. They're like, this is weird. I'm not used to having to report to someone. I'm like, I don't want you to view me as your boss. I'm not. This is a partnership. And, this is a flat organization in my mind. And I think once they kind of realize that, they tend to get over it.
Yeah, that's definitely an interesting piece to come in, even with us, like, coming in and assisting, partnering with businesses on marketing side.
Yeah,
like, it's we're the same, like, we're working together for the same goal, increase your business.
Exactly.
We do that, like, it doesn't affect us, like, we're not over you or anything like that, because we've had some conversations with founders. We're like, well, this is my idea of marketing or media, and like, we understand we're trying to help you with our, where our strengths are. We're not taking over, we're working together. And it's sometimes it's a good conversation because they're just not used to, like you said. And so
for sure. And like, it's very different with a majority investor.
Sure.
So someone that owns like 51% of the business, that is your boss. They own the business. They control what happens in the business. So, we own, many times 20 to 40%. So we don't control the business. So that's why, I don't like when people view me as a boss, and they shouldn't. I'm not.
Sure. Yeah. And that's what you said. You guys usually you don't do majority ownership, correct? Most of the time.
Yeah, correct.
Yeah. Would there be something that you would love to be like, yeah, we'll do majority on that? Is there something that you're super bullish on?
Yeah, I mean, we're not opposed to it. But even that scenario, like, candidly, I think there's one or two businesses where we do own majority. To me, the percent ownership is a little bit of an output of just check size and valuation. So the ones where we do own majority, there's a scenario where there's a non-active founder who wants to liquidate, or maybe there's an early investor who needs to return capital to our please. So that's how the check size gets above majority. But even in those, it's not in our operating playbook to act like a majority investor. So sometimes a majority investor, a large PE fund, they have people on their bench just hanging out there. Sometimes they call them entrepreneurs or residents or something, and they're waiting. It's like a successful founder from another business that they're waiting to plug into a new business. We don't have that. We don't want to operate the businesses. That's not our playbook. So the ones where we do own majority, we don't act like a majority investor in that, right?
Yeah. So when people are watching, so this just came up when you talk about majority owners and things, Shark Tank, right? Where does that compare into like what you guys are doing? Is that set because they're venture capitalists, right?
Yeah, I'd view them as venture capital. So people are going and kind of pitching an idea that might have a little traction. That's for sure. That's more on the VC side, and that's like that show is not a good representation of how this world actually works. And we've talked to a lot of people who have been on the show, and they just view it as a marketing ploy, and like you for their own product. And you see the scenarios where Mark Cuban says, I'll give you 500K for 40% of your business or something. And then they may even shake hands. And then it's a little stage, like he doesn't actually invest because there's more things that matter besides just the valuation. The devil is in the details. So and then sometimes that's for prop share and all that. And, so there's a legal aspect that happens as well. So I think most of those don't transact. But to answer your question, yeah, that's like much earlier stage VC. Like I don't get off a call and offer someone a valuation and a check. There's more diligence that goes on to get to that.
Because I've always wondered with that, like they, do that deal and then how does it actually turn out after? Like, do they actually help them? Like, because I'm sure they're super busy, like all these businesses that they throw out their deal to. So you're saying not all of those actually happen.
Yeah, I hope Mark Cuban doesn't come after me for saying this. I've talked to people who have been on the show, and that's it's not, hey, they have a handshake deal. Like, great. There's a lot more to it than just valuation and check. There's all these legal minority protected provisions and all that they got to figure out. And a lot, sometimes deals fall apart on that.
Yeah, that makes sense. A lot more things they have to explore after, but it makes it a good talk. All right. So,
yeah.
Cool. There's actually somewhere we got a business locally here we know that was on the show and ended up not getting any deals from it based on their debt and stuff. But they finally got rid of that. And so it's just an interesting thing to hear about. And the equity, the VC stuff is all interesting. And I think you've made a good kind of highlight on what it is, what you guys do. And really, I mean, do you think not anyone should just look for equity, right? You're looking, there should be limits, millions a year in revenue before.
Well, yeah, I mean, it depends what you want. Like I said, like there's a great, like Silicon Valley has a great venture capital model, and they may give someone with a great idea and a huge total addressable market size, $20 million to go build it and figure it out. Like they're going to have high loss rates.
Sure.
So they're going to lose a lot of money, but they're also going to have winners like a Facebook and that more than makes up for the losers. Where Volition plays in the growth equity world, it tends to be lower loss rate, but you're still going for, big outcomes. But, for a venture capital fund that has a low loss or a high loss rate, so losing a lot of money, if you have a 3X, it kind of like a 3X return on your capital invested, it almost doesn't matter. You need to have like the 10, 20, 50Xs to make up for some of the losses, where for us, if you don't have a lot of losses, 3X on a fund basis could be a great return. And however, we're shooting for 10, 20Xs as well. It's just a little bit of a different model.
Yeah, interesting. It's all fascinating. And so I appreciate you being on here and sharing. Are there any deals that you wish you could go back and redo because it did maybe work out like you thought, or it didn't come to fruition and, it did really well as far as the business doing well?
Yeah, I mean, we always say there's kind of two things that are pretty common in this industry. One is that you'll have an anti-portfolio. So these are that's kind of a term that people talk about. It's like the companies you might have passed on, or to your point, like couldn't agree on valuation, that go on to be big businesses. And then candidly, like I mentioned, we have very low loss rates as a fund, but if you don't have a loss here or there, you're probably not taking enough swings of the bat and taking enough risk to have those really big outcomes. So it's a balancing act, obviously. And you want to have a situation where you don't ever lose money. That's really hard to do in this industry. Not every business is going to work out the way that you think. So, I mean, some lessons learned on like, a business where I didn't have the outcome that I wanted was more on like a regional rollout and So this is business, was more consumer facing, and they would go into each city and kind of roll their product out. Realize that's hard. Like when we invested, they had 5 cities or so, and they're all kind of in a pretty tight geographic dispersion. Over time, realize that once you start having locations in California and Texas and the East Coast, the management team can't manage those as well. And every, local city had its own hyper locality nuances. So I think what happened in that business, we had a few markets and cities that were doing really well, a few that were middling, and a few that just like couldn't figure it out. And it was just like hard to scale with that kind of mix. So that's kind of one lesson I took there. And, I'd say like on the anti-portfolio, I've had plenty of misses. Like everyone showed you don't have enough good deal flow. Those are the ones, honestly, that don't bother me because like there's a reason I passed for it at the time. Yeah. Maybe I feel like the valuation was crazy. Maybe, they were retention was poor and they're going through new product development that brought them to somewhere else that increased over time or something. The ones that bother me are the companies that I knew were good companies and I couldn't break through to them. Like those that keep me up at night. And I've had some of those where, I'm offering meetings in a, random city because I know that they're based there, or trying to get them to meet at a conference and they're not taking the calls, and, our analysts are sending them hundreds of emails and voicemails and so forth. And we just can't break through. In those scenarios, most of the time I'll try to get a warm introduction from someone who knows them or something like that. But many times they might say, hey, I'm purposely not responding because I'm not taking any of these calls right now. And then out of the blue, you find out that they raised capital from someone else. Like those are the ones that keep me up at night.
Yeah, I'm sure that has to be hard, especially when you see them, do good and you could have helped or been a part of it. And last question, I'm curious too, like with the ones you've helped that have been successful, do you notice the founders have, or the most of the founders have a specific trait that sets them apart from, normal, quote unquote, average people that make them successful?
Yes and no. So it's funny you ask this because we do so much business diligence and market diligence. And I think as a firm, we're lighter. We're not lighter. It's harder to quantify why we want to back a founder. Sure. You just kind of have it in your gut of like, this person is special and they're going to make money. And that's all the founders that we back. So we actually, when we had an intern over the summer, we had them pull all attributes of all of our successful and maybe less successful investments across, 100 different attributes and try to find some commonality. There kind of wasn't any. It was pretty interesting. Like a few things that I remember that stuck out to me was your education did not matter. If you graduated college or went to an Ivy League school, did not matter. We've had successes on both sides. I think if their age tended to matter less, where I thought that might have been a key contributor. Granted, there's a smaller sample size. This is our own fund. I'm sure someone with a larger fund and more investments could come up with their own attributes. But there were a few things that did stick out. One of them was founder team size. We tend to have like 2 to 3 is the sweet spot we found. I think if it's kind of one founder, many times, and that's not to say all one founder teams are, unsuccessful. We just had more success where it's differing points of view around the table. So I love a founding team or a management team where there's a optimist and a pessimist. I think that they balance each other out well. If you have 2 optimists, or 2 pessimists, that's not less of a great scenario because they're going to probably agree. Groupthink happens. And, one founder doesn't have someone that they can bounce ideas off of sometimes. But otherwise, I feel like, it's one of the attributes is you gotta be a little crazy. You gotta be a risk taker, because I would not be able to just quit my job and take the risk to go start a business and bet on myself. So I give every founder, no matter how successful the business is, even if it fails, a ton of credit for going out on a limb, having an idea, and going to make it happen. So that's what I love about this industry, is talking to folks that are, believe in themselves and their product so much that, they're willing to take that risk when they might have a family and a mortgage and all that to pay for.
Absolutely. No, I love that. And it's an interesting thing that there wasn't one standout thing, which is, I think, a good thing. I think it's, That's really cool. So again, I really appreciated this conversation with you today. If people are looking to learn more from you or get connected, maybe they're ready for, equity, some capital injection. Where's the best place for them to connect with you at, Jim?
Shoot me an email. Very simple email, jim@volitioncapital.com. And if you want to follow me on Twitter, I'm trying to get more active there. It's @JimFerryVC as well. But I'm always happy to take a call.
Awesome. Well, yeah, everyone, if you're interested or want to learn more or, get more information, definitely connect with Jim. And again, Jim, thanks so much for being on the show today.
Thanks, Chris. Appreciate it.
Absolutely. And if you're listening to this, again, if you aren't yet, make sure you follow the show. This just helps us keep doing what we're doing, put out more episodes. And I want you to stay tuned. We're going to have a little bit of a rebrand things coming forward to make the show even more clear on what we do. So that's exciting. We're coming up on the 500th episode, which is going to be a big episode. And lots coming to continue to help you guys out. So follow the show. Make sure you don't miss out on that. Share this episode with somebody so we can help more people together. But until next time, continue to go out there, elevate your life, elevate your brand, and we'll talk to you again soon.